Good morning, ladies and gentlemen. I'm going to welcome you all to our Ifrs Hot Topic session that we are hosting today. I think we'll just give it another minute or two to get a few more people to join, and then we'll start. Thank you. Just turned 9 o'clock, and I would like to welcome all of you to our IFRS Hot Topic session that we are hosting today on behalf of BDO. And welcome to you all. Thank you for your attendance. When we were looking at the topics for this session, our main aim was to look at issues that we see our clients have been asking us questions about, new developments in IFRS, new changes that are coming up, and for those of you who are listed entities, specifically from a JSE perspective, looking at those focus areas from the JSE that they will be focusing on in the next review cycle. Because we know the proactive monitoring process and that review cycle is an issue for most companies, and you don't want to be on the JSE's radar. So once again, thank you for your attendance. Really appreciate it that you've made the time to come listen to us this morning. Just before we get to the content for today, I just want to highlight some of our IFRS resources that we do have available from BDO that is hosted on our IFRS microsite by BDO Global. I've got the link on screen, and I'll just quickly show you the site to give you an idea of what's available. And after the session, you will get a copy of these slides, so you'll have the link available to actually go there and see what information is available. If you were to go to the Ifrs reporting site, it's set out very clearly and very logically. Ultimately, we've got our resource library on top, and in here we've got our resource library, and it's broken down into the main standards that have been issued over the last while. And if you were to go into the resource library, all our BDO publications are listed below here. So you'll see our Ifrs at a glance publications, our Ifrs in practice publications, which are publications, the detailed publications around our specific, the specific standards. And then also our model Ifrs financial statements. These will be for interim results, as well as for your full year end results financial statements. Our illustrative financials with suggested disclosures and example disclosures are all available there. One other feature that we've added to the resource library in the last 2 months is an IFRS frequently asked questions tab. And the idea with this was to put together all the specific topics in one place so it's easy to find. So for example, if you're looking at events after the reporting period and you click on that, it would list any publication that we specifically as BDO has available on that topic. And then it also would include any IFRIC agenda decisions that has been published relating specifically to that standard, all in one place. I just want to show you one other example, for example, for cash flow statements. If you were to go to cash flow statements, again, if we've got specific publications available, it would be listed here on the top, and towards the bottom, all the IFRIC agenda decisions are set out with the detail relating to what those decisions were. This is a really cool resource that's available to use with all the IFRIC agenda decisions categorized per topic and our publications. You will see our Ifrs in practice publications are our longer publications where we basically deal with specific topics. The specific one relates to cash flow statements. which has been quite a hot topic from a JSE perspective, from a regulator perspective on what is correct and what is not correct from a cash flow statement. One other thing that we also include in our resource tables is some online training. There is some online training courses available that there is some online training courses as well. So if you're on the main Ifrs reporting page, you will actually see our online training link. And these are web-based training, mainly the biggest standards has been released over the last few years. And what we've also been doing lately is after IFRIC meetings, there is summaries and training available relating to those topics that I've discussed at those IFRIC meetings. So really very valuable resources that are available for everyone to use and to access. Just to get to today and today's agenda and today's presenters, we've got most of our IFRS team presenting to you today, and we thought it's a good idea for everyone to be involved, so you can see who the team is, and you can see who you talk to or who the people are at BDO's IFRS team. The first session we're going to do today, Glenys Carthy is going to deal with complex financial instruments. After that, Michelle Boerta will be looking at the JSE proactive monitoring report back that the JSE issued late last year and what they're looking at and what they found. We'll then have Kyle talking to you about the IFRS 3 amendments relating to the definition of a business combination. Amira Barta will be discussing some IFRS 16 lease modifications. And then last but not least, Ulrike van der Horst would be discussing some IFRS 16 and IAS 12 practical issues that we found during our consultations with clients and with audit teams. To try to make these online sessions a bit more interactive, we do have some polling questions that we're going to send out during this presentation. You'll see a QR code on your screen now, which you can scan with your phone's camera. Most phones, if you just take the camera and scan it, it will take you to the link. It will take you to the first poll, but you won't be able to answer yet as we haven't opened it yet. I would suggest just stay on that page. And if you see the next poll come up and it hasn't refreshed, just refresh your browser and it will automatically go to that next poll. If you don't want to use the QR code, you go to www.menti.com on your phone and use that code 52449643. We've also posted that site and code in the question answer session, which you should see on the top right of your screen. There's a QA button. You can access that and you can see what's been published. We have published it there, but it will also be shown on each poll screen if you lose it or if your phone loses connection for some reason. On the topic of questions and answers, please feel free to ask questions during the session in the QA function. You can type it in there. We will look at that and we will then answer them at the end of each individual session. We will give feedback on those questions. We might not have time to give feedback on all of those, but where we don't have time, we will send the answers to those questions to the individuals that asked it. So if you want us to get back to you, please just include your name so we know who it is. Otherwise, it comes through as anonymous. Yeah, and that is really my intro. I really just want to welcome all of you again to the session today. And then I'm going to hand over to Glenys, who's going to talk to you about some complex financial instrument issues that we find. Thank you, Glenys.
Right, morning. Thank you, Tianis. Just to confirm that you can actually see my screen.
We can, thank you.
Okay, great. So morning, everybody, and welcome to my session where we will be looking at complex financial instruments. Now, this is not a new topic, but it's one that's quite complicated. And what we'll be focusing on is trying to identify when there is a complex financial instrument and how we go about looking at whether we classify something as debt or equity. So, or sometimes we need to split one instrument into different components, and each component might be classified as either equity liability or derivative liability. So that's what I'll be touching on.
Sorry to interrupt, your screen didn't share. Can you just share it again, please?
Okay, will do. Okay, just let me know if that has a shared now.
No.
Apologies, I'm not sure what is happening there. Right, that should be sharing.
There we go. Thank you.
Right, perfect. Thanks. Sorry about that. Okay, so let's move then into the content. Now, today we're going to be focusing on convertible notes. And before we look at examples of those, a convertible note is a financial instrument that either will definitely be converted into equity shares of the company that is issuing that financial instrument, or may be converted into those equity shares. And the typical examples that we find in practice of what are called convertible notes or loans that are convertible, or bonds or preference shares. And so whenever we now refer later on in this presentation to convertible notes, it could be any one of these that we actually are speaking about. The common features that we find in convertible notes is that they can either be mandatorily convertible, or sometimes they are convertible at the option of one of the parties. So the issuer or the holder could have that option. Sometimes you might find where the issuer has an option, it can choose to either pay cash or to issue its own shares or its own equity instruments in return for settling that obligation that it has. And then we also find contingently convertible notes where they only convert when a future event occurs, and sometimes those events are under the control of the issuer and or holder, and other times they're not, so there's specific guidance around that. Then there are what is called down round clauses and anti-dilution clauses, and these are, they won't necessarily be phrased this way in an agreement, but they're clauses where either the pricing changes or the number of shares changes, and that can have quite significant impacts on how you classify something. So when we're looking at our polling examples later on, we will be looking at some of these features. One of the aspects that is important, or maybe the reason that we're covering this, is that although it's not a new topic, it's a very complex part of IFRS. So that's really sort of just to emphasize that the reason for us covering it. So although there are two fundamental forms of financing, being liability and equity, when we apply the accounting standard, which is IAS 32, the standard that deals with how we present financial instruments, what you find is that the accounting doesn't always follow the legal form. And that's then what makes it very complex. So IAS 32 on its own is quite a complex standard because you can read one paragraph and you sort of reach a tentative conclusion based on that paragraph. But if you don't consider the entire standard, you could actually be arriving at the wrong conclusion. And then the other standards that would apply to recognition, measurement and disclosure, we're not focusing on these today, but just so that you know, IFRS 9 is a financial instrument standard that deals with recognition and measurement. And IFRS 7 is a financial instruments that deals with the disclosures of financial instruments. And IFRS 13 deals with disclosures of fair value, which we obviously see quite often when we're looking at financial instruments. Now, obviously, the first issue is why is this such a big issue? Now, the first aspect, I suppose, is that most companies would prefer to have a credit to equity than a credit to a liability, and it'll make their ratios look a lot better. But the second issue is that the accounting is actually significantly different. And so if we get our classification wrong, then clearly we will have a wrong IFRS answer. So I'm going to just take one example where we have what is called a compound financial instrument, where there's a portion that's liability and a portion that's equity, and just tell you, just explain how they differ in the accounting. Now, when we're looking at initial recognition and measurement, what we're required to do is to fair value this liability component first. So let's just say that the face value of an instrument happens to be 2 million rand and the fair value of the liability component is 1.5 million. Then what we do is we take the difference between the two minus the 1.5, and we attribute that to equity. So the residual value is what is attributed to equity, so the 500,000 in my example. Then we come to subsequent measurement. And in general, liabilities are subsequently measured at amortized cost. But you do find some instances where you would be required to fair value it. So, for example, one of the possibilities that I touched on earlier on is that we could have something classified as a derivative liability, in which case you would then measure that at fair value through profit or loss. However, with equity, once you've initially recognized it, it's not remeasured. And then the last aspect that we'll touch on is transaction costs. So these are transaction costs as defined in IAS 32 and IFRS 9. And what we do for a liability is it depends on how the liability is classified. So if the liability is measured at fair value through profit or loss, then what you do is you immediately recognize these transaction costs in profit or loss. However, if that liability is not measured at fair value through profit or loss because it's measured at amortized cost, then what you do is you debit that transaction cost to the liability, and it changes the effective interest rate. So what it means is that from an accounting perspective, you recognize a higher interest rate over the life of the liability, and basically you write it up to maturity value by adjusting this effective interest rate. However, for equity, when there are transaction costs related to an item that is classified as equity, then those are deducted from equity in accordance with IAS 32. Now, the trickiest part, I think, one of the trickiest parts is not focusing only on legal substance. And then the second tricky part is when you've got a complex financial instrument is knowing how many components there are. And so it's very important to look carefully at the terms, because those terms will help us identify how many components there are. And then what you do is you decide how each component should be classified. And there are three commonly observed types of financial instruments, and some of them have got more than one component. So I'm going to start off with a liability. And this is when all components, or there's only one, all components meet the definition of a liability, or there's only one component that meets the definition of a liability. The second we've already touched on. We saw a compound financial instrument where there's a portion that is a liability and a portion that is equity. And then the third we haven't yet touched on, it's called a hybrid financial liability, where a portion is classified as a liability and a portion is classified as a derivative liability. Now, this slide and the next two slides are really here for information purposes that you can look at afterwards. This is one of the examples that Tianis was just touching on when he said we've got an IFRS in practice. We've got several IFRS in practice publications. This specific one deals with convertible notes, and it's got very good examples in it and a lot of detail, much more detail than obviously we are able to cover today. In this publication on page 9, there's a flow chart, and what this flow chart does is really take you through the requirements in IAS 32 and help you decide whether something should be classified as liability, equity, or derivative liability. And you do need, I would really encourage you to use this flow chart to help you get to the right answer. But one thing I do want to point out is that if you're not separating a financial instrument into different components, and applying this flow chart to each component separately, then you could well get the incorrect answer. So aggregating components could give you the wrong answer, even if you did apply this decision tree. This is just the definition of a financial liability and an equity instrument. We're not going to go through it because the slides that follow will just pick up on some key issues in these definitions. So there's two aspects that you need to consider when you're trying to decide on whether something is a financial liability or not. And the first one is whether the entity has a contractual obligation to deliver cash or another financial asset that it cannot avoid. And if you conclude that the entity does not have an unconditional right to avoid delivering cash or another financial asset to settle this contractual obligation, then the obligation meets the definition of a financial liability. Now, there's certain exceptions that exist in IAS 32. In real life, those exceptions are not often met, so I would encourage you just to be careful about assuming that they're met, and if you do think they're met, I'd encourage you to consult further on that. But what it does is it just allows certain financial liabilities, there's an exception where they could be presented as equity. The other area where you need to think about is whether that contract will or may be settled in the issuer's own equity instruments. Now, later on, we're going to just point out that simply because someone's not paying cash doesn't mean there's no financial liability. And again, simply because somebody is issuing shares or something else that would meet the definition of an equity instrument also does not necessarily mean that it's not a liability. So you'll see here that it says the instrument is classified as equity only if either one or two is met. So the first thing that we need to decide is the part that we're looking at, the component, is it a non-derivative? And if it is a non-derivative, then it must include no contractual obligation for the issuer to deliver a variable number of its own equity instruments. The other option is, of course, it could be a derivative, and in that case, it must be settled only by the issuer exchanging a fixed amount of cash or financial assets for a fixed number of its own equity instruments, and we call this the fixed for fixed criterion. So these are two key aspects that we just need to pick up from the definitions of financial liabilities and equity. I do want to highlight some points as well, that when we're deciding whether, and I'm going to work in an anti-clockwise direction, hence my numbering here. So firstly, when we decide whether something should be classified as equity or liability, we are making that assessment from the perspective of existing equity holders. So let's say you come to a conclusion that something should be classified as equity, either the entire instrument or a portion thereof. Then you really could just do with taking a step back and saying, well, does that component or the entire instrument put the holder of that instrument in exactly the same position as the holders of existing equity instruments? And if not, then the chances are that it probably should not be classified as equity. The other aspect, which I've sort of touched on, is that IAS 32 is very complicated. And the reason for this is that it contains principles, but then it's got some rules that override the principles. And then the other aspect is that you do need to read the application guidance in IAS 32. So I would encourage you to make sure that you read all the relevant sections in IAS 32 before you decide on how you classify something. The third aspect just to highlight is, as I've mentioned, sometimes someone will say to me, the company doesn't have an obligation to pay cash, therefore we must credit equity. But that is actually not necessarily a correct statement, because as I've mentioned previously, we don't only think about whether the company has an obligation to pay cash. Sometimes a financial liability can arise even when a company is issuing shares or will issue shares. And then lastly, instruments are classified based on their rights and their obligations. And what I'd like to point out here is that it's extremely important to read an agreement fully. Because just like with IAS 32, where if you pick up one paragraph, you can get to the wrong answer, Likewise, if you pick up 1 or 2 paragraphs in an agreement, you can get to the wrong answer. And just on the agreement, I would encourage you, if you haven't had experience with this classification beforehand, to rather consult before an agreement is finalized, because what we find in practice is that companies sign an agreement, think that the credit will be equity, and unfortunately they get to a different answer when it comes to the actual audit. So please do consult as early as possible, and you know, it may well be possible for you to change clauses to get the desired outcome if that makes economic sense. Just on these rights and obligations, what it does say in IAS 32 is that economic compulsions do not have any effect on classification. What it means by that is that you mustn't think about what an entity is likely to do. You only consider what its rights and obligations are. Having said that, it can make it sound like we only think about the legal rights and obligations and therefore we ignore substance, and that is incorrect. So, for example, there's a concept which we've sort of highlighted very briefly about contingent options, which we spoke about earlier on, but you also get contingent settlement provisions. And paragraph 25 of IAS 32 requires us to assess whether that's genuine or not. So, in other words, sometimes we'll ignore it if we determine that it's not actually genuine, based on the guidance in IAS 32. This is a slide that we've seen previously. The reason I've just replicated it here is on the next slide, we're going to be looking at an example of each of these. And it's just to emphasize again that we need to consider each component within that financial instrument. And of course, unfortunately, the way that the agreements are written, they're not split into each component. So it takes, you know, a little bit of time to be able to identify each component. So let's start off with a compound financial instrument. So we've got a company that issues a convertible note that firstly has got a specified annual coupon, or it might just be phrased as interest, or sometimes it's phrased as a dividend. And secondly, there's an option for the holder of that convertible note to receive either the principal repayment or to convert the note into a fixed number of ordinary shares of the issuer on maturity. Now, in this instance, there are 2 components. The first portion is a liability, and that liability is for the specified annual coupon and the fact that there's an entitlement to receive repayment of the principal on maturity. And then the second aspect that we've got is an equity portion, and that relates to this option where the note can actually be converted into a fixed number of ordinary shares on maturity. So that's the first example where we're showing 2 components. Let's look at the next one where we're looking at a hybrid financial liability. In this instance, it's exactly the same. So there's a convertible note with the specified annual coupon, and there's an option for the holder to receive the principal repayment or to convert. But what's different in this one is that the method of conversion is different. So the issuer, what will happen is that the holder will receive a variable number of shares that is based on the weighted average price of the shares for a specified number of days before maturity. So let's look at those 2 components. There also is a liability, as there was here, for the coupon and the principal that is repayable on maturity, or could be asked to be repaid on maturity. And then there is a different answer here. We don't have it classified as equity, even though it could be settled in shares. But because it's a variable number of shares here, and it's a derivative, what we do is we then fair value this through profit or loss. So you can see just a small change in the way that the conversion would work changes our classification of those components. And then the last aspect is a debt instrument where we've got specified annual coupon and a principal that is repayable on maturity. Now, before we look at the answer there, I just want to emphasize that please don't look at this description of a debt instrument only from a legal perspective, because we can have something that is legally a share, but from an accounting perspective is a debt instrument. So in that instance, where there is a debt instrument, then as we had for this liability and this liability here, the coupon and the principal that is must be repaid on maturity give rise to only one component, basically a liability. Okay, before we move on to polling questions, I do just want to point out a couple of other aspects that, especially when we've got these convertible instruments, and so this is why I'm saying in real life, you also need to think about, well, what happens if that option to convert is not exercised? Now, what does the agreement say in those circumstances? So to understand whether interest continues to be paid until it is finally converted, or maybe even into perpetuity. And the reason for this is because when interest is paid on an instrument in perpetuity, then IAS 32 has got a paragraph that says that the entire instrument is classified as a liability. Then sometimes what happens if an option isn't converted when it can, sorry, if that option is not exercised, then the whole instrument becomes mandatorily redeemable. And in other instances, you might find a situation where the holder of the instrument had the choice to convert and didn't convert. And now the agreement might say that the issuer has a choice. So it's really trying to understand, what happens if it's not actually exercised. And sometimes agreements are quite specific about this. Sometimes you need to look a little more carefully. So what I would encourage with these polling questions that we're going to look at, which you'll see there are 3 of them, is please just go with your gut instinct, tempered a little bit by what we've heard so far on the, in this session. But of course, please do think about whether there is more than one part or more than one component. And if there is, then you need to assess each component separately. So let's start off with the first polling question. Company A issues preference shares, referred to as prefs, for 1 million. The prefs pay a 10% annual coupon or interest or dividend. They would typically be phrased as a dividend in an agreement. The prefs are not redeemable, but the holder has an option to convert 1 million rand into Company A shares after 3 years. The conversion is based on the average of the lowest 5 days volume weighted average price, or VWAP, of the last 30 days prior to maturity. Does Company A classify the prefs as number 1, a liability, number 2, an equity instrument, number 3, an instrument with 2 parts, being a liability part and an equity part, or number 4, an instrument with 2 parts, being a liability and a derivative liability? But so you should have your browser open on the menti.com. If not, then just go there and enter this code 52449643. And please don't worry about whether you get this answer right or wrong. Just the purpose of this is to help us identify things, to help us work out what the classification should be. So I'll give you about a minute. And Tianis is just monitoring the responses, and he'll just let me know when we can move on to the next slide.
We have quite a few responses coming in, but I'll just give it another few seconds.
Okay,
before
perfect.
I give you the results. Just before I give the results of the poll, I just want to let everyone know, if the screen is blurry on your side, please just at the bottom right of the screen, there's a quality setting which you can elect. And it seems like normally it's on auto. but lately auto doesn't always work great. So you can click on that quality setting and change it to 720p or 540p, and your slides will be much clearer. Okay, the result of the poll is we've got 12% saying 1, a liability, 10% number 2, an equity instrument, 43% of participants number 3 with 2 parts, and 36% number 4, an instrument of 2 parts, liability and derivative liability.
Okay, perfect. Thanks, Tianis. So let's go to the next slide where we look at the answer, and what you'll see is that number 4 is correct, and this instrument has got 2 parts, being a liability and a derivative liability. Now, what I'm going to do is we are on the next slide, we're going to debrief this derivative liability aspect. But I want to just take you back to the question to show you where the liability part creeps in. Because Company A is obliged to pay this annual dividend / coupon / interest of 10%. That gives rise to a liability. And so as soon as you see that there's an obligation to pay any amount, then you know that there should be some portion, at least, if not all the portion, but if there should be some portion that is a liability. And so let us go then to the debrief on the conversion feature. Now, just before we talk through it, what I've done here is I've put the questions that get us to this answer in the flowchart. So we're not going to go to the flowchart because we haven't worked through it, but in your own time, you can go to each of these questions and see how we get to the answer. So we are only debriefing the conversion feature, not the compulsory coupon of 10%. So just to remind us about that conversion feature, the holder has the option to convert 1 million rand into Company A's shares based on the average of the lowest 5 days VWAP of the last 30 days prior to maturity. So what we can see is that moving to the left here, is that there's no contractual obligation to pay this 1 million rand in cash. But obviously, if that option is exercised, then the settlement will be in Company A's own equity instruments. So the holder can choose to get that. And then what you'll see is that this is a derivative, and it is to be settled other than by a fixed amount of cash for a fixed number of its own equity instruments. So in other words, the fixed for fixed criterion is not met. So that's why I've crossed it out there. The reason it's a derivative is that what you'll see is that the number of shares that the holder would get when they convert changes based on the share price and the VWAP of Company A. So therefore, the value of what they're getting in exchange for that 1 million is also variable. The net investment that is originally made is smaller than would otherwise be required, and it is settled at a future date. So this is really explaining the definition of a derivative and how it's met. So that's why we get to a derivative, and because it's a derivative, we would fair value it through profit or loss, and we would do that at each reporting period. Now, just to point out here is that this classification would change if these prefs were convertible based on a fixed price per share. So the reason that we get to this derivative answer is because the price isn't fixed, and then you know, obviously they're going to land up because of that with a variable number of shares as well. So then the facts that we have at the moment, there's a small change or a value change. It might be small, it might be large in response to the share price, which is a derivative. So that's the first polling question. The second polling question, Company A issues a 1 million note. The note pays a 10% annual coupon. On maturity, which is after 3 years, the note is mandatorily convertible into 100 equity shares of Company A. And again, does Company A classify the note as a liability? That's number 2, an equity instrument. Number 3, an instrument with 2 parts being liability and equity. Or number 4, an instrument with 2 parts being liability and derivative liability. And thanks, Tianis. I'll just wait to hear from you. This one should be a little bit quicker. Now that there's a little bit of, we've been able to just work through the first one.
Glynis, we've got 95% of the respondents saying number 3, an instrument of 2 parts, liability and equity. And the others are saying number 2, an equity instrument.
Okay, thank you. So let's look at the answer. Well done then. It is 2 parts, liability and equity. So before we debrief the equity portion, just to remind you again that if we know that there's this fixed coupon, then we know that there's always an element that would be a liability, and which is then why option 2 wouldn't be the correct answer. So again, I've got the question numbers there for you. We know that there's no contractual obligation to pay cash. In this instance, the 1 million will not be paid in cash because it's mandatorily convertible into 100 equity shares of Company A. So we know that settlement is in Company A's own equity instruments. It's not a derivative, and that's because the initial investment is 1 million rand and not nil or a lesser amount. And there's also no obligation to deliver a variable number of own equity instruments. It's a fixed number. 100 equity shares will be issued on conversion, and therefore that meets the definition of equity. Okay, then our last polling question. Company A borrows 1 million rand from Company B. The loan is interest-free. On maturity, Company B has the option to convert the loan into 100 equity shares of Company A. Does Company A classify the notes as a liability, an equity instrument, an instrument with 2 parts being liability and equity, or an instrument with 2 parts being liability and derivative liability? Okay, so again, might be a little bit easier than the last one. We actually started off with the most difficult one, really. Yes, how are we looking?
Just waiting for a few more votes to come in.
Okay.
We're only on about 20 votes at this stage after 223 attendees. Okay, we've got more votes in now. We are majority, 57% is number 2, an equity instrument, 25% on option 3, 22% option 1, a liability, and small percentage, 4% on option 4.
Okay, thanks. I think that what the answers demonstrate is that none of these are simple issues. They do take some time to get used to them, but yes, the answer is number 2, an equity instrument. And again, we will debrief on the next slide, but I do just want to emphasize why there is no liability here. And that is primarily because there is no obligation to pay any interest, and there's also no obligation to repay the 1 million on maturity. So the only thing is that there's this option to convert the loan into a fixed number of shares of Company A on maturity. So because there's no contractual obligation to pay cash, and because settlement will be in Company A's own equity instruments, we then need to consider whether whether it's a derivative or not a derivative. Now, the value of this varies in relation to the share price. So, for example, if the 100 equity shares that the companies get, that the holder would get in Company A are worth 1 rand, then in effect they will have landed up giving 1 million rand and getting 100 rand back. But obviously you can see that if that value happens to suddenly be 5 million rand, then they would only have paid 1 million rand for 5 million rands worth of shares. So the value varies based on the share price. So because it's a derivative, we then need to understand how it will be settled. Is there a fixed amount of cash for a fixed amount of own equity instruments? So in this instance, the fixed for fixed criterion is met because you're swapping 100 equity shares for 1 million rands worth of cash. And so therefore that is classified as equity. I want to just highlight one aspect to be very careful about is if this loan had been denominated in US dollars and the company was a South African company with a functional currency of rands, then we would not get to an equity answer because, of course, when we convert US dollars to rands, we don't have a fixed amount of cash. So we would have a variable amount of cash being exchanged for a fixed amount of own equity instruments, these 100 shares. So you can see that a small clause or a small change, just the denomination of an instrument, can change the classification. Okay, so that is all that I need to cover. Thank you so much for your time. Tianis, are there any questions before I hand over to Michelle?
We have not received any specific questions on this section, Glynis, so we can hand over to Michelle for a session. Thanks.
Okay, perfect. Thank you very much then.
Yes, off mute, Michelle.
Thank you, Tianis. Thank you, Glynis. Good morning, everyone. I hope everyone is well and looking forward to some findings raised by the JSE in their reporting back on proactive monitoring of financial statements in 2021. The objective of the JSE's process of reviewing annual financial statements and interim results is both to ensure the integrity of financial information and to contribute towards the production of quality financial reporting of entities listed on the JSE. This aligns with one of the general principles of the JSE listing requirements, namely to enhance investors' confidence in this market. In our view, any issuer, listed or not, will find benefit in this report. Let's now look at detailed findings raised in this report. The first focus area was the impact of COVID-19. If we look at the background, in its first set of interims published after the COVID-19 outbreak, a property entity included the following: limited commentary when referring to tenant relief measures. So they stated that negotiations with tenants on COVID-19 related areas are ongoing. This limited disclosure triggered a series of inquiries which unraveled to expose a recognition error. At their interim reporting date, no rent concessions had been granted by the issuer and no tenant contracts had been terminated. Given what the issuer regarded as significant uncertainty regarding the collectability of the rent during the hard lockdown, rental income for this period was recognized only to the extent it was probable that it would be received. This resulted in a significant portion of unrecognized rental income not being recorded in the 2020 interims. During the JSE's inquiry process, the issuer explained that they intended to recognize at least 25% of this amount in the AFS as the probability of collection had subsequently increased. The view was that Ifrs 16 does not contain a collectability threshold for the recognition of a lease income, and they therefore developed a new accounting policy based on Ifrs 15, which is the revenue standard. So if we look at the JSE's response to this, the JSE found that it was inappropriate for the issuer to look to the IS 8 paragraph 10 hierarchy in developing an accounting policy for this matter. And this is because paragraph 17A of IS 1 indicates that management uses the hierarchy in the absence of an IFRS that specifically applies to an item. And in this case, paragraph 81 of Ifrs 16 specifically deals with the revenue recognition of operating lease contracts, and the impairment requirements of operating lease receivables fall within the scope of Ifrs 9. The issuer previously applied established accounting policies for both recognizing revenue and testing receivables for impairment, and this aligned with the requirements of Ifrs 16, and Ifrs 9. And therefore, we wouldn't expect this to change under the COVID-19 pandemic. IS 34 paragraph 28 states that an entity shall apply the same accounting policies in its interims that are applied in its AFS. and it's also inappropriate to depart from IFRS to achieve a particular presentation of an entity's financial performance. The outcome was that the issuer restated the interims to recognise the previously unrecognised rental income and separately considered the collectability of the receivables under IFRS 9. The next focus area was on the fair value of investment properties. In this matter, investment properties were the most significant assets for the issuer. In their 2020 interims, issued in the midst of the COVID-19 pandemic, the issuer stated that investment properties was last revalued at the previous financial year end. Caution needs to be exercised by the user of this announcement, bearing in mind that the valuations were performed without the COVID-19 impact. So we could expect the JSE to have an issue with this, and they noted specifically in IS 1 paragraph 18 that it states that an entity cannot rectify inappropriate accounting policies either by the disclosure of the accounting policy used or by notes or explanatory material. The objective of the interim report is to provide timely and reliable financial information aimed at improving the ability of investors to understand the group's financial condition. IS 34 paragraph 28 determines that an entity applies the same accounting policies in its interims as are applied in its AFs. The issuer's accounting policy is to subsequently measure investment property at fair value, so consequently, fair value measurement must be applied in the interims. The issuer also initially asserted that there was no reliable information available with which to prepare valuations at the interim reporting date. IS 34 paragraph 41 notes that the preparation of interim results will generally require a greater use of estimation than for AFs. IFRS 13 paragraph 9 defines fair value as the price that would be received to sell an asset at the measurement date. In a South African context in which the issue operated, a buyer would not pay the same price for an asset at, say, today as they would 6 months later. Market conditions are not always perfect. In instances of widespread disruptions to markets, such as this COVID-19 pandemic, reliance is placed on unobservable inputs applied in the valuation technique. Paragraph B, 23 of IFRS 13 describes the expected present value technique as a possible valuation approach. In doing so, it describes as a starting point the use of a set of cash flows that represents the probability weighted average of all possible future cash flows. IFRS 9 paragraph B 5.5, 41 and 42 applied by analogy also explain that estimates are neither a worst case scenario nor an estimate of a best case scenario, but rather an estimation that reflects a range of possible outcomes. On further inquiry, it transpired that the issuer was indeed able to estimate the fair value, and the JSE found that the issuer had not complied with IFRS and they had not remeasured the investment properties to fair value at the interim date. If the issuer's original assertion regarding the inability to make an estimate was correct, which it was not in this case, but let's just say it was correct, the results would still have been lacking in compliance with IFRS from a disclosure perspective. And this is because IS 1 paragraph 7 states that applying a requirement is only impractical when the entity cannot apply it after making every reasonable effort to do so. The JSE would expect an issuer to apply at least the following when considering expected future cash flows, and this is for fair value measurement and for impairments. Firstly, assess feasible future scenarios. For example, the end of COVID restrictions by a specific date, continuation of current wave structure, or worsening of the existing situation. Secondly, determine the cash flows that relate to each scenario. So the return to normal, continuation of outcomes with the effect becoming worse. And then applying probabilities to each of the scenarios. It is impossible to envisage a scenario where the high impractical threshold of paragraph 131 is triggered in each of the above 3 steps. We expect that an issuer is likely, at the very least, to be able to apply steps 1 and 2. Management is likely to be considering this type of information in its budgeting process. Should step 3 be problematic, applying paragraph 17 with paragraph 131 would compel the issuer to provide all available information that they consider to conclude that it was impractical to complete the determination of an estimate. The issuer is required to disclose the information in steps 1 and 2 together with an explanation of the reasonable efforts that they made, including explaining what prevented them from completing the estimation exercise. An interesting finding was negative confirmations. We have seen economic circumstances change due to COVID-19 and the July 2021 civil unrest. Users may want to understand why particular events did not impact the user. For example, in an industry where the credit risk of debtors has deteriorated significantly, users may expect a similar increase in the ECL and may be left with unanswered concerns if this does not occur. In these circumstances, a negative confirmation and supporting explanation as to why the economic event did not significantly impact the issuer's financial results is often as useful as the detailed disclosures that are provided in cases where the economic event did have an impact. These type of disclosures apply equally to year-end financial statements and interims, and if included, should also avoid a question being raised during the review process. The JSE also raised some points on previous findings. The first one was the presentation of financial statements. IS1 was the single largest contributor to the JSE's findings. It accounted for 52 different findings across 29 different issuers. The following paragraphs featured in 60% of those findings. Paragraph 122, including entity-specific information about judgments made. And this is apart from estimation, so the focus clearly on judgments made by management. And those are the ones that have the most significant impact on the amounts recognized. Paragraph 117, providing accounting policies. So this was specifically focused on unusual transactions and unusual accounting treatments. Paragraph 17C and 31, providing additional disclosures when compliance with the specific requirements in IFRS are insufficient to enable a full understanding. Again, the focus on unusual and complex transactions. Paragraph 25, detailed disclosure to support the going concern assumption. That's become a bit more relevant during the COVID-19 times. And then paragraph 113, consistency of presentation between various notes. Just again focusing on the judgment area. So matters covered here look at like factors considered when making the determination of the functional currency for a subsidiary, why the call option held by the issuer was not substantive and why this did not result in the entity being consolidated, what made an acquisition an asset acquisition rather than a business combination and vice versa, why the issuer only identified one cash generating unit when they appeared to have 3 separate business units, and how a business met the definition of a discontinued operation. The important question I think we should focus on is, after reading the disclosure in the AFS, will an independent user have a full understanding of the entity-specific circumstances supporting the judgment without needing to ask management for an explanation? The JSE's reviews found the IFRS 13 disclosures of 20 individual issuers from a wide range of sectors to be insufficient. Areas included either the partial or entire omission of significant unobservable inputs, both in identifying them and quantifying the amounts, or the sensitivity analysis for changes in those inputs. There was also an over-aggregation of disclosed inputs. Issuers still apply materiality incorrectly. The JSE disagreed where an issuer had only focused on the size of assets in the context of the balance sheet without due consideration applied to the possible income statement impact of fair value changes. Another focus area from previous findings relate to financial instrument disclosure. In both the 2019 JSE New Standards Thematic Report and the 2020 JSE Report issued February 2021 provide detailed IFRS reference discussions and examples on these matters. We would not expect this to remain an issue, but it seems to still come up. The JSE reached agreement with 18 issuers that the disclosures under IFRS 7 across a range of topics were insufficient. The biggest area of weak disclosure related to expected credit loss calculations in terms of the omission of ECL assessments being carried out on other receivables, disclosing entity-specific inputs and assumptions, details that demonstrated how forward-looking information had been incorporated into calculations, and information that explained how changes in the gross carrying amount of receivables contributed to changes in the ECL. It is expected that issuers should reach a level of maturity on their understanding of their obligations in this area, and that there will be reduced findings in the future on this topic. Issuers are requested to ensure that the IFRS 9 sections of the above-mentioned reports are specifically considered by their audit committees to ensure a full understanding of the topic. Again, we refer to that Annexure 3 in this report. The common finding table was included for the first time in the JSE report issued in February 2018. Poor application of the disclosure obligations of IAS 36, which focused on impairments of assets, has featured as a common item since then, and this year is no different. The findings continue to reveal the omission of all or some of the minimum obligations of paragraph 130 to 134 of IAS 36. In 2021, this occurred for 14 issuers. The JSE looked for explanations for significant changes in assumptions and disclosures where a reasonably possible change in a key assumption might lead to an impairment. In order to understand B above, they asked some issuers to provide them with the amount of the available headroom in their impairment calculations. Those inquiries revealed that certain issuers had very little available headroom and that a very small change in assumption could lead to an impairment. In such an instance, the entity must provide disclosures quantifying the headroom, the value assigned to each key assumption, and the amount by which such key assumption must change for there to be an impairment in terms of IAS 36. The JSE believes that items A and B are areas where audit committees can play an active role in ensuring that the necessary disclosures are provided. I think this is a good tip for us to look out for. Look at your available headroom, and that will guide you to ensure compliance with this disclosure. The last finding relating to previous findings is the tax rate recon. The JSE found shortcomings in the disclosure of IAS 12 of 7 issues across 3 topics. The tax rate recon not providing meaningful information for multi-jurisdictional entities, over-aggregation of items within the tax rate recon, and insufficient entity-specific disclosure supporting the recognition of a deferred tax asset. This finding has also been coming for a while, and we expect issuers to get this right. Another material case focused on headline earnings per share. Paragraph 18 and 19 of the SAICA headline earnings circular explain that the circular creates detailed rules for all items to ensure consistency. Deviations from the rules are not permitted, even if an entity believes that the distribution between trading and platform remeasurements is inappropriate for their specific business. Section C of the circular states that financial instrument adjustments arising from the application of IFRS 9, whether as a result of revaluation, impairment, or amortization, except for all reclassified gains and losses for a hedge of a net investment in a foreign operation, should be included in EPS and not be adjusted for. The JSE findings detected 2 instances where items were erroneously excluded from headline earnings. One of these findings related to the impairment of loans. The issue explained that the loan was made to an associate. The loan was viewed as being akin to the investment in the associate. They therefore followed the treatment applicable to the impairments on equity accounted investments in associates and excluded the impairment from headline earnings. This was incorrect as the loan remains a financial instrument under IFRS 9. The circular is a rules-based document and deviations from the detailed rules are not permitted. BE transactions is still a big focus area as issuers struggle to get this right. In vendor finance transactions, the company issuing the shares also provides the necessary financing to the BE party to subscribe for those shares. This financing is repaid through dividend receipts on the underlying shares. In most cases, the identifiable consideration received or to be received by the company is less than the fair value of the shares issued to the BE party, and the discount indicates that other consideration has been or will be received by the entity. This is then treated as an equity-settled share-based payment expense in terms of IFRS 2, whereby the substance of the transaction rather than its legal form is recorded. The shares, whilst legally issued, are accounted for as an option. They are only reflected in the AFS as issued shares once the underlying financing has been repaid. This is often through dividend receipts on the underlying shares. The JSE, however, considered an instance where an issuer had embarked on a BE transaction where they did not directly advance the funds to purchase the shares. Instead, the issuer guaranteed the BE party's loan obligation to a third-party financial institution. The issuer accounted for the transaction at inception by recognizing a share-based payment transaction under IFRS 2, but then also the nominal value of the shares issued to the BE party as a normal share issue transaction. The argument was that it was necessary as the entity had received cash from a party external to the group. Then in subsequent years, the BE party defaulted on its loan repayments to the financial institution, and the financial institution called on the underlying guarantee, and the issuer had to repay the outstanding balance of the BE party's loan. The issuer recognized the ensuing loan obligation, now triggered as the guarantee was called on, against equity. And they were arguing that this was effectively undoing a previous equity transaction. But this meant that the BE party was represented as both the owner of the issuer's shares and the holder of an option over those same shares. The issuer's justification for BFIF was that the benefit for the BE party was similar to that of an option. The BE party bore no obligation to the financial institution to repay the loan. They could walk away with no liability to the financial institution for the subscription price of the shares or the related interest on the loan. Whilst the legal and accounting situation may have been different, only one relationship, so only one economic event representing this BE transaction should have been reflected in the AFS. The JSE found that by issuing the guarantee to the financial institution, the issuer bore the legal obligation for this liability from day one. When receiving the cash for the shares issued, the issuer should have recognized the liability to the financial institution rather than recognizing an additional credit leg to equity. This is supported by IS 32 paragraph 19b, which explains that a contractual obligation, which is conditional upon a counterparty exercising its right to redeem the instrument, is a financial liability. And this is because the issuer does not have the unconditional right to avoid delivering cash under this arrangement. That was a bit of a mouthful. Now let's look at the 2022 focus areas raised by the JSE. So IS 1 paragraph 99 requires an entity to present an analysis of expenses recognized in profit or loss using a classification based on either their nature or their function, whichever provides information that is reliable and more relevant to the entity. Paragraph 99 refers to either or with respect to presentation format. Therefore, the JSE have raised questions where issuers have used a mixture of both nature and function on the face of the income statement. Issuers have explained that they are looking to balance the obligation of paragraph 99 with paragraph 97, which calls for the separate disclosure of the nature and amount of material items. In such a scenario, these issuers have demonstrated that they can still achieve compliance with IFRS by clearly identifying the function related to a specific expense along with its nature on the face of the income statement by using subtotals and or by providing additional notes to the financial statements. The JSE have seen instances where issuers present such items, for example depreciation, separately and neglect to link the item back to its relevant function, for example cost of sales. If the by function format is being applied, there must be a clear link tying items that are presented by nature to their relevant function in order to avoid unintended non-compliance with paragraph 99. Under understanding that a proportion of the depreciation and staff costs are absorbed into the cost of inventory, which becomes cost of sales when sold, issuers should clearly explain how the separately disclosed expenses relate to other line items presented on the face of the income statement. For example, is the separately disclosed depreciation expense the total depreciation expense for the period or only that portion that was not absorbed into inventory to become cost of sales? Paragraph 103 cautions that whilst the by function method can provide more relevant information to users than the classification of expenses by nature, allocating cost to functions may require arbitrary allocations and involve considerable judgment. The JSE believes that a mixed presentation should not unduly elevate the importance of certain expenses over others, and that ultimately the performance of the issuer must be fairly presented. Still looking at 2022 focus area. Let's do a polling question. Entity A incurred significant goodwill impairment losses due to the impact of COVID-19 on their business. How should the impairment loss be disclosed on the statement of comprehensive income if the entity presents the expenses by nature? Should it be A, above the subtotal operating profit as abnormal goodwill impairment, or B, below the subtotal operating profit as goodwill impairment, or C, above the subtotal operating profit as goodwill impairment? Please go to www.menti.com and enter the code 52449643. I'll just give a few seconds to do the polling question, please.
If the poll hasn't updated on your browser, you can just press refresh and it should update and go to the slide that's currently on. Thanks. Michelle, we've got 40% of participants saying number 2 below the subtotal operating profit, and then about even percentage between number 1 and number 3, about 30-odd%.
Thank you, Tianis. So the answer is actually C, above the subtotal operating profit as goodwill impairment. But I'll give you a detailed explanation now on how the JSE looks at this. So let's go through it. The JSE agrees that highlighting the impact of an expense directly attributable to COVID-19 or the recent civil unrest may be required or allowed by IFRS to the extent that it is material. IAS 1 paragraph 97 requires such disclosure. The concern raised by the JSE, however, lies with how such items are labelled, how the judgments to reliably measure what aspects of that expense are directly attributable to COVID-19 compared to normal operations are applied and disclosed, and then also their positioning in the income statement. The JSE May 2020 letter reminded issuers of the constraint under IFRS that items of income or expense cannot be presented as being extraordinary. They have challenged issuers who use the term abnormal, which they believe is in substance the same as extraordinary and therefore prohibited by IAS 1 paragraph 87. The best suggestion is to describe the nature of the income or expense on the face of the income statement rather than labelling it as non-recurring, abnormal or extraordinary. If the issuer applies a by-function approach to the income statement, they must still ensure they comply with paragraph 99 that we discussed now earlier. The second consideration is to ensure that information is reliable and ensure faithful representation. An issuer looked to quantify the impact of COVID-19 by comparing the actual results to budgets and presented this difference as being attributable to COVID-19. This is a very difficult route to follow and might not lead to faithful representation. An issuer would need to have absolute confidence that their financial controls over their budgeting processes are effective. The issuer would need to be able to reliably isolate the impact of all factors that contributed to the non-achievement of the budget. If the issuer can justify this and presents a COVID-19 item, it should be accompanied by detailed disclosure of judgment applied by management in calculating such figures. Let's look a bit at the subtotals. The use of additional subtotals are required in terms of IAS 1 paragraph 85 only when such subtotals are relevant to the understanding of an entity's performance. The use thereof is however subject to the requirements of paragraph 85A. Furthermore, paragraph 15 requires fair presentation and that an entity must faithfully present the effects of transactions, other events and conditions. The JSE challenged an issuer who included the subtotal trading profit in the income statement, but excluded the movement in expected credit loss from the subtotal. They argued that the exclusion did not lead to fair presentation being achieved, particularly as the entity had many banking operations, which were considered part of their normal business activities. Another example is looking at IFRS 12. It requires an entity to disclose information that enable users to evaluate the nature, extent, and financial effects of interest in joint arrangements and associates. The JSE have identified instances where there is an inconsistency in the presentation of the income from the associates and the profit on sale of shares in associates and/or impairments of loans to associates. Item A was presented below a subtotal called the operating income after impairments, while item B was included within the subtotal. They challenged this inconsistency. They're concerned that all of the income streams linked to the associate should be within the same section of the income statement, so either all part of operations or not, in order for the financial effects of the interest to be understood. The last example relating to the use of subtotals, the ISB noted in the BCs that an amount disclosed should be representative of activities that would normally be considered to be operating, considering comparability and ensuring that information is not misleading. For example, it would be inappropriate to exclude items clearly relating to operations, such as inventory write-downs and restructuring and relocation expenses, because they occur irregularly or infrequently or are unusual in amount. Similarly, it would be inappropriate to exclude items on the grounds that they do not involve cash flows, such as depreciation and amortization expenses. It is difficult to envisage which expenses, if any, would not be regarded as being part of the issuer's operating activities. An analogy to I7 paragraph 6 may be appropriate, where operating activities are defined as the principal revenue producing activities of the entity. Significant impairments, even those attributable to COVID-19 pandemic, may occur as a consequence of normal business activities of the entity. Whilst COVID-19 was clearly an unexpected occurrence, for most entities the consequential financial impact is tantamount to a business risk. So the JSE challenged issuers who had separately disclosed the impact that impairments had to the financial performance and included this below an operating profit subtotal on the face of the income statement. I think we should be very careful in using subtotals. That's me for the findings on the JSE proactive monitoring findings. I hope you can take something away from it and it was not too boring. Tennis, was there any questions that you might want to mention?
There were no questions I would like to mention at this stage. I might come back to the questions at the end.
Thanks. You, Tennis. Thanks. I'm then going to hand over to Amira. We'll touch on IFRS 16 modifications. Thank you, Amira.
Thank you, Michelle. Hello, everyone. I hope you're enjoying the training thus far. This morning, I'm going to be showing you how to deal with IFRS 16 lease modifications by way of an example. So let's start by reading the fact pattern. ABC Limited entered into a lease agreement to rent 500 square meters of office space. The company's year end is December. The lease starts on 1 January 2021 and ends on 31 December 2022. The monthly rental for the 2021 year is 100,000 and 110,000 for 2022, and the incremental borrowing rate is 10%. The lessee and lessor then signs an addendum to the original lease on 1 January 2022 to amend the original lease by reducing the office space from 500 square meters to 250 square meters. In addition to this amendment, they also agreed to extend the lease period by an additional year. So the new monthly lease payments for 2022 is now reduced to 45,000 and 50,000 for the 2023 period, and the revised incremental borrowing rate is 8%. Please take a minute to answer the polling question. How should the changes in Addendum A be accounted for as a separate lease or to a modification? Please select an answer and Tianis will provide us the outcome of your votes shortly.
Just going to wait a few more seconds for some more responses to come in.
Okay, thank you, Tianis.
%93 of participants are saying number 2, that it's a modification.
Okay, well done. That's the correct answer. So the answer here is 2, because the changes made in Addendum A should be accounted for as a modification and not a separate lease. I will just explain the reason for this in a moment. Ifrs 16, Appendix A defines a lease modification to be a change in the scope of a lease or the consideration of a lease that was not part of the original terms and conditions. A lessee accounts for a lease modification as a separate lease if both of the two conditions exist. That is, the modification increases the scope of the lease by adding the right to use one or more underlying assets, and the consideration increases by an amount equivalent to its standalone price. So in our example, there is no additional right to use one or more underlying assets, which means there is no increase in scope, and therefore it is not a separate lease, but rather a modification. Now, if the modification does not meet the conditions to be a separate lease, the next question is to ask, does the modification decrease the scope of the lease? If the answer is no, it does not decrease the scope, then the lease liability should be remeasured by discounting the revised lease payments at the revised rate and making a corresponding adjustment to the right of use asset. However, if the answer is yes, it does reduce the scope, then the accounting is more complex. Although the liability is still measured in the same way by discounting the lease payments in the modified contract at the revised discount rate, the adjustment is performed in a two-step process. And I'll explain this process in a minute. But before that, please take a moment to answer my next polling question. How should the changes in Addendum A be treated? As an increase in scope due to the extended period, or a decrease in scope due to the reduction in square meters, and then an adjustment for the extended period?
Gonna wait another 20 seconds. But 70% of respondents saying number 2 and the other 30 saying number 1.
Okay, that's great. Remember that an extended period is not considered an increase in scope, and therefore the answer is the changes in Addendum A is a decrease in scope because of the reduced space, and then also an adjustment needs to be made for the extended period. Okay, good. Now that we concluded it is a decrease in scope with an extended lease term adjustment, we know that we will need to follow the two-step process. In step 1, the carrying amount of the right of use asset and lease liability at the date of modification is reduced to reflect the partial termination of the lease. And the difference between the carrying amount and the right of use asset that's derecognized gives rise to a gain or loss in P&L. And then in step 2, the carrying amount of the liability resulting from step 1 is adjusted again to ensure its carrying amount equals the future lease payments in the modified contract discounted at the revised rate. So the second adjustment to the lease liability is accounted for by making a corresponding adjustment to the ROA. So how do we apply this to our example? Firstly, we need to know the pre-modification right of use asset and lease liability at the effective date of modification, which is 1 January 2022. So we get these balances from our original IFRS 16 calculation using the original 10% discount rate and the initial 2-year period. And once we determine these pre-modification balances, it must be reduced by the proportionate decrease. So what I mean by that is the 500 square meters is now decreased to 250 square meters, which is a 50% reduction. And therefore, the lease liability is adjusted by this 50%. And we do the same thing for the right of use asset, which gives us the 630,000. The adjusting journal for step 1 will be debit the lease liability, credit the right of use asset, and the difference between the two will go to profit or loss. In this case, we will recognize a gain of 58,000. And finally, step 2. We need to calculate the new modified balance by doing IFRS 16 calc using the modified terms. Excuse me. So using the reduced payments of 45,000 and 50,000 respectively, the new discount rate of 8%, and that gives us a balance of 1 million on 1 January 2022. So in summary, we start with the pre-modification lease liability. On date of modification, decrease it by the proportionate reduction of 50%, which gives us a 630,000. And then we do a further adjustment of 424,000 to get to the new modified balance of 1 million. This is then how the second adjusting journal will look by debiting the right of use asset worth 424,000 and making a corresponding adjustment to the right of use asset. And we end up with a modified ROU balance of 996,000. And that's it from my side. Thank you very much. Dennis, are there any questions before I hand over to Kyle?
We haven't received any questions on this topic, so we can continue with Kyle. Thank you, Amira.
Thanks.
Morning, everyone. I'm going to have a look at the amendment to Ifrs 3, which amended the definition of a business. Now, this standard was effective on 1 January 2020, so it might be a bit older for some people, but we often don't see business combinations every year, so it's useful for us to look at it still. Today, we're going to focus on the optional concentration test, which can ease the burden of doing business accounting in certain business combination accounting in certain scenarios. So we're going to start by doing a knowledge check to gauge an understanding of the optional concentration test. So in our example, Small Investor Co. SIC purchases a portfolio of 24 bedroom apartments. Each house is in the same geographical area, includes the land, the house, and the property improvements. Each house has a different layout and its own separate rental agreement, but the demographics of the tenants is similar. The fair value of the consideration paid is equal to the sum of the fair value of the 20 houses. We can assume that the risks of the properties in the portfolio are not significantly different, and there are no employees or other activities transferred to SIC. So if we assume that SIC elects to apply the concentration test, let's determine whether the test has been met. So we've got option 1, yes, it has been met, and option 2, no, it hasn't. So we'll just wait a minute or two for you to submit your answers.
Carl, we've got 70% saying yes and 30% no.
Thank you, Tennis. So the 70% are correct. The optional concentration test is met in this case because substantially all the fair value of the gross assets, being the 20 units, is concentrated in a group of similar identifiable assets. So let's revise by having a look at what the concentration test entails. So before the amendment to Ifrs 3, if an entity acquired a group of activities and assets, we would go straight to Ifrs 3 paragraph B8 to B12D to determine whether the set of activities and assets acquired should be accounted for as a business combination or an asset acquisition, depending on whether the definition of a business was met or not. Now, what the optional concentration test does is it inserts a step before going to those paragraphs. What the optional concentration test will then do, if it is met, is we go straight to the asset acquisition accounting. So we don't have to consider whether it is a business or not, and by virtue, we don't have to do business combination accounting. So it can reduce the onus of reporting by not having to do business combination accounting. So what does it entail? It requires that substantially all of the fair value of the gross assets acquired is concentrated in a single identifiable asset or group of similar identifiable assets, which essentially means that you have paid effectively for one specific asset. Now, this is an optional test, so you don't have to use it. But should you use it, and should the requirements be met, the acquisition would be counted for as an asset acquisition. Should the test be failed, or should you not elect to apply the test, you go to Ifrs 3, where we consider whether the definition of a business is met or not. So there is some guidance in determining or performing this test. The first is determining the fair value of the gross assets acquired, and it works by looking at the consideration paid, which includes the fair value of any NCI and the fair value of any previously held interests, as well as the liabilities assumed. So we don't actually calculate the fair value of those assets, we look at it from the fair value of what is given. Now, when we're considering the gross assets acquired, we always ignore cash and cash equivalents, deferred tax assets, and goodwill resulting from the effects of deferred tax liabilities. In terms of a single identifiable asset, this is a single asset or a group of assets that would be recognized as a single identifiable asset in a business combination. Now, there can be a scenario like with our houses example, where we have two assets in the form of the house and the land. Now, where tangible assets are attached to each other and they cannot be physically removed or separated without incurring a significant cost or a significant decrease in utility or fair value, they are considered a single identifiable asset. So that's why in the example, we take the house and land together, because the house will obviously lose a lot of value if we demolish it to separate it from the land. Furthermore, the risks involved in each asset need to be similar. So in our scenario, although the houses had a different layout, they were of a similar nature with a similar type of tenant and therefore contain similar risks. In terms of aggregating assets together, the standard is explicit on certain combinations that can't be aggregated. So a tangible asset and an intangible asset can't be aggregated. Tangible assets in different classes can't be aggregated. So for example, inventory and manufacturing equipment, unless they are considered a single asset like we previously discussed. Going back to intangible assets, again, if they are of a different class, so brand names and licenses, for example, could not be aggregated. Financial and non-financial assets cannot be aggregated, and again, within financial assets of different classes, for example, an account receivable and an investment in an equity instrument also cannot be aggregated. So now let's look at two examples, one with the concentration test and one without it. So in our first example, Bazaar Centres, BC, purchases a large shopping centre, LSC. LSC operates one shopping centre that includes 450 specialty retail shops and 5 anchor tenants. At the date of the acquisition, all shops are individually leased. The LSC employs a workforce of 50 people who are responsible for operating the information desk, cleaning and looking after the common area, basic maintenance and negotiating leases. The LSC has documented processes and systems that are used to generate revenue, and all the staff will continue to be employed after the acquisition. The total consideration paid was 415 million rand, and BC incurred acquisition costs of 3 million rand. So what did BC acquire? They acquired land of 300 million, the shopping centre itself of 210, so the shopping centre is built on the land, cash and cash equivalents of 5 million rand, some intangibles that were identified on acquisition of 4 million rand, there's a bank loan of 100 million, other financial liabilities of 5 million, an employee benefits provision of 1 million, and then deferred tax liability arising from temporary differences of 70 million. So the total fair value of the gross assets acquired is 516 million, which we calculate as the 415 million paid, plus all the liabilities of 106 million, excluding the deferred tax liability, less the 5 million cash and cash equivalents that's acquired. So in our first polling question, BC elects to apply the concentration test. So the question is, has the concentration test been met? Option 1 is yes, option 2 is no.
Well, I'm just waiting for a few more responses. The polling question slides has just gone out on the live event. There was a bit of a delay.
No problem.
We are sitting on 60% saying no and 40% yes.
Okay. So if we go back to our figures, the fair value of the assets acquired, we calculated as 516 million. We can take the land and shopping centre together as they cannot be easily separated. So the sum of the land is 300 plus buildings of 210, which is 510 million. So the correct answer would be yes. We've effectively have a fair value of 516 versus the value of the gross assets, which is 510. And that comes to 98.8% of the total value. So the concentration test in this scenario is met, and it would be accounted for as an asset acquisition. Now in polling question 8B, BC elects not to apply the concentration test. So now we divert to Ifrs 3, paragraph B8 to B12D to determine whether the assets and activities acquired meet the definition of a business or not. So yes, if we can open the next polling question for us. Option 1 is that yes, the definition is met and it's accounted for as a business combination. And option 2 is no, it is not met and it is accounted for as an asset acquisition.
We've got 70% saying it's a business combination and 30% saying it's an asset acquisition.
Thank you, Tilas. So the 70% are correct. There are sufficient inputs, so we have the shopping centre itself. There are processes, there's documented processes, a workforce, etc. And these inputs and processes are creating an output in the form of rental income. So had BC elected not to apply the concentration test, they would have accounted for this as a business combination. So it's interesting to see how applying the concentration test could reduce the level of work required for this acquisition. Okay, Tianis, do we have any questions?
We have received no questions, so we can continue on to Ulrika. Thank you, Carl.
Thank you, Tianis. I'll hand over to Ulrika.
Sorry, I think I didn't unmute myself. Good morning, everyone, and thank you for staying with us until now. So I will be covering the last few topics in our training session, and so after that bit on Ifrs 3, we are now moving back to Ifrs 16, as well as some IS 12 practical issues. So the first two topics are Ifrs 16 leases implementation issues, where clients have raised questions in scenarios where the application of the standard is not that clear. And so BDO has arrived at a global firm view on the most appropriate treatment. My third topic will be the new IS 12 amendment. So let's get right into it with a poll. And the first poll deals with Ifrs 16 and VAT. On 1 January 2019, ABC enters into a 5-year lease agreement to rent office premises. Monthly rental payments payable in arrears are 1,167 currency units, including VAT. VAT is 15%. The incremental borrowing rate is 8%, and ABC is a registered VAT vendor, and therefore the VAT paid can be recovered. The question is the VAT payment to the lessor a lease payment as defined in Ifrs 16? Please could you go and vote? Your options are yes or no. Dennis, have we got a...
Just going to give it a few more seconds.
It's not such a hard one. It's not a trick question.
We've got 98% of people saying no.
Okay, brilliant. Well, that's a great response. So the 98% got that right. So the reason is that on the one hand, that VAT payment does not meet the definition of a lease payment, which is payments relating to the right to use an underlying asset. But on the other hand, that portion is recorded as a receivable or a reduction of the payable when your payment is made. So it goes to your VAT control account. So this accounting should not come as too much of a surprise to you, but I just wanted to do that as a background before we get to the next scenario. And in our next poll, the facts are the same, except that the VAT paid by ABC cannot be recovered. So we are dealing with a company that is either not registered for VAT or delivers supplies that are exempt from VAT and therefore cannot claim input VAT on certain expenses. So the question is irrecoverable VAT a lease payment that should be included as part of the lease liability measurement? So in this instance, the VAT cannot be recorded as a receivable because it's not refundable. So the issue is how to then account for it. There are three possible views. View one is that it's not part of the lease liability measurement because it's not a lease payment as defined. View two is it's also not part of the lease liability measurement, but it is an initial direct cost of the asset. And view three is that actually one should view the VAT as being part of the lease payment because it is non-refundable and payable to the lessor. So please could you take a moment to vote.
We've got 80% of participants saying number 3, yes, and 20% saying no, number 1.
Okay, so that's interesting, and I think that is perhaps why we've decided to include this issue in today's session, because our BDO view is that option 1 is the most appropriate treatment, and that option 2 might also be acceptable, but option 3 would not be appropriate. So let me explain why. Ifrs 16, the appendix, defines a lease payment as payments made by a lessee to a lessor relating to the right to use an underlying asset during the lease term. So we would say that the VAT is not a lease payment because it doesn't actually relate to the right to use an underlying asset. What is happening here is the VAT is a charge levied by a government relating to goods and services, with the lessor merely acting as a collection agent for the government. So what we need to look at is, if it's not a lease payment, how should we be accounting for it? And that VAT is then viewed as being within the scope of IFRIC 21 levies. Yes, there is an IFRIC called IFRIC 21 levies. And this one, in paragraph 4, they define a levy as an outflow of resources embodying economic benefits that is imposed by governments on entities in accordance with legislation. So when we are in the situation, or when a company is in a situation where they are not able to recover that VAT, that payment actually falls squarely into that IFRIC 21 levy scope. So therefore, the VAT should not be included in the measurement of the lease liability or the right of use asset. Any non-refundable portion would be expensed when the underlying transaction occurs. And this is because paragraph 8 of that IFRIC tells us that the obligating event that gives rise to a liability to pay a levy is the activity that triggers the payment of the levy as identified by the legislation. Now, in our South African context, the obligating event is the invoicing by the lessor of each scheduled lease payment. So based on that, the calculation of the lease liability is done by discounting our monthly lease payments excluding VAT, using the incremental borrowing rate, which will get us to a lease liability of 50,000 currency units. And then as each scheduled lease payment becomes due, the irrecoverable VAT would then be expensed at the point at which it becomes payable. And this is what the journals will look like. You've got your initial recognition of your ROU asset and lease liability excluding VAT. And we, once you make the lease payments, there's a portion, you've got your normal amortization of the lease liability, and then there's a debit that goes to VAT expense for the VAT portion of each payment. So the key message on this topic is that irrecoverable VAT should not be included in the measurement of the lease liability and should be expensed at the point when it becomes payable. All right, so our next issue relates to accounting for deposits paid as part of leases. And we've got another poll. Strawberry Inc. is a technology company that designs, develops and sells consumer electronic products. Strawberry enters into a lease for a retail space with the following terms. The lease term is 5 years and the payments are 2,000 currency units per annum paid in advance. Upon commencement of the lease, Strawberry is also required to pay a refundable deposit of 1,000 currency units. The deposit is refundable without interest at the end of the lease term, as long as the property is maintained in the condition as required by the lease agreement. If Strawberry damages the property beyond normal wear and tear, the lessor has the right to use some or all of the deposit to repair the damage at the end of the lease term. However, the lessor is not expected to use part or all of the deposit to restore or repair the asset. So what I would like you to consider now in the next poll is how Strawberry, the lessee, should account for the top deposit made as part of the lease. Is it option 1, a form of a lease payment? The deposit should therefore be included in the measurement of the lease liability and the right of use asset. Or is it an initial direct cost of the lease, option 2, or option 3 as a financial asset within the scope of IAS 32 and Ifrs 9? Please could you now go and vote. Dennis, have we got a...
Yeah, we have a 40-40 split between number 1 and number 3 and 20% in number 2.
Okay, that's interesting. Well, then probably also useful that we are covering this poll, because the correct answer is option 3. So that deposit is a financial asset within the scope of IAS 32. So let's have a look why. The deposit is not a lease payment and it's not an initial direct cost of the asset because it is refundable to the lessee at the end of the lease. The lessee has a contractual right to receive cash from the lessor at the end of the lease term as long as it complies with the applicable covenants of the lease, and therefore that falls squarely into the definition of a financial asset in IAS 32. Okay, so the contractual right to receive cash from another party. Therefore, we need to account for the financial asset in terms of Ifrs 9, which requires financial assets to be measured initially at their fair value. In this scenario, the asset would be classified as measured at amortized cost. So if we now attempt to fair value this financial asset, we are receiving 1,000 currency unit cash flows in 5 years with no contractual interest. That would give us a discounted at 5%. We get to a fair value of 784 currency units. And note that the discount rate that we use is not the incremental borrowing rate of the lessee, but instead a discount rate that reflects a lending arrangement between the lessee and the lessor. Because the lessee is effectively lending the lessor 1,000 currency units interest-free for 5 years. Next, we need to consider how to account for the difference that arises from discounting. Paragraph B 5.1.1 of Ifrs 9 states that if part of the consideration given or received is for something other than the financial instrument, then the entity shall measure the fair value of the financial instrument, which we've done, and any additional amount lent is an expense or a reduction of income unless it qualifies for recognition as some other type of asset. So we are needing to decide whether that difference from discounting needs to just be expensed immediately or whether there's some other way that we need to account for it. So how should the lessee account for that difference? The lease deposit paid to the lessor arises in the context of a lessee-lessor relationship, and therefore the difference would be an adjustment of the consideration paid by the lessee to the lessor. Economically, the lessee has provided an interest-free loan to the lessor. It therefore forms part of the cost of the right of use asset. So the journal entry that we would be required to do for that deposit is to debit a financial asset for the fair value of that deposit, the discounted amount, and then to debit the right of use asset for the difference. That difference would then be accounted for subsequently the same way as the rest of that right of use asset, and of course we credit cash paid. Now, in some scenarios, the deposits may be interest bearing, in which case this whole discounting issue won't arise. But the takeaway, though, is that lease deposits are financial assets and should be included in the IFRS 7 disclosures for financial assets. Our final topic and question deals with the recent amendment to IAS 12 on deferred tax related to assets and liabilities arising from a single transaction. For example, a lease under IFRS 16 gives rise to the recognition of both an asset and a liability in a single transaction. Before we get into the question, a very quick reminder of some basic principles when you are calculating deferred tax. According to the balance sheet method, you need to compare the carrying amount of assets and liabilities with their tax base in order to calculate the temporary differences. Those are then multiplied by the tax rate to arrive at your deferred tax. As part of this process, you will also sometimes need to consider if the initial recognition exemption applies to certain temporary differences. Then we also need to just remind ourselves of the definitions of tax base. So the tax base of an asset is the amount that will be deductible for tax purposes against future benefits when the entity recovers the carrying amount of the asset. By contrast, the tax base of a liability is its carrying amount less any amount that will be deductible for tax purposes in respect of that liability in future periods. So we now have our last poll, and Strawberry Inc. entered into a 10-year lease for a retail space in a shopping centre. At the commencement date of the lease, Strawberry Inc. calculated the carrying value of the lease liability and the right of use asset as 500 currency units each. And just in this scenario, there are no amounts that cause the initial measurement of the lease liability and the right of use asset to differ. For tax purposes, a deduction can be claimed for the contractual lease payments paid or accrued in respect of that financial year, and the applicable income tax rate is 28%. The preliminary deferred tax calculations are summarised in this table below. So for the lease liability, the carrying amount is 500, the tax base is 0 because the tax base is the carrying amount less the full 500 lease payments that will be deductible in future. That gets us to a tax base of 0 and a deductible temporary difference of 500. The right of use asset has a carrying amount of 500 and a tax base of 0 because nothing is deductible for tax purposes on that asset, which leads to a taxable temporary difference of 500. So with that, the question is, should deferred tax be recognised in respect of the lease liability and right of use asset temporary differences at the time of initial recognition? Your options are 1, yes, because the initial recognition exemption does not apply, or no, because the initial recognition exemption does apply. Please, can you go and vote? Tennis, have we got results?
Just waiting. There's a bit of a lag today between live event going out, so I'm just waiting a few more seconds. Okay, I think I've got enough now. We've got 80% saying yes and 20% no.
Okay, well, I'm happy with that answer. So I will cover the detail of the initial recognition exemption in the next slides because it is a bit of a complicated thing, but theoretically either answer would have been acceptable prior to the amendment to IS 12. And this is precisely the issue that the amendment to IS 12 was seeking to address because there was a diversity in practice. So there were different views on what the correct treatment should be, and consequently the ISB amended the wording of the initial recognition exemption so that it would not apply to the initial recognition of a lease liability and an ROU asset. So the answer in option 1, which 80% of you chose, is the correct answer when we apply the new amendments. However, in the South African context, it seems that many companies have been applying this approach anyway. So the revised initial recognition exemption criteria are as follows. Deferred tax assets and liabilities shall be recognized for all taxable and deductible temporary differences, except to the extent that these arise from A, the initial recognition of goodwill, or B, the initial recognition of an asset or liability in a transaction which, 1, is not a business combination and at the time of the transaction affects neither accounting profit nor taxable profit or loss. Now you'll probably remember those bits, but number 3, at the time of the transaction does not give rise to equal taxable and deductible temporary differences. That item 3 is the amendment to IS 12, which the ISB introduced in order to clarify that the exemption should not be applied when a lessee initially recognises a right of use asset and a lease liability. Note that without the amendment, there were certain users who applied the initial recognition exemption and therefore didn't recognise deferred tax on leases because they said a lease does not affect accounting or tax profit at initial recognition, which is strictly speaking correct. But I think the answer of recognising deferred tax, I think, is more in line with the overall spirit of what IS 12 and deferred tax is trying to achieve. So what is the accounting impact from a deferred tax perspective? Deferred tax therefore should be recognised on both the taxable and deductible temporary differences arising on the lease liability and right of use asset. At initial recognition, those two will offset, but the deferred tax balances will vary subsequently over the lease term because the amortization of the lease liability and the ROU asset occur differently. So we have a deferred tax asset of 140 and a deferred tax liability of 140 related to the ROU asset. So lastly, the effective date of this amendment is periods beginning on or after 1 January 2023, with earlier application permitted. But if you have been applying this anyway, this will not really have any impact. So that's all from me and wraps up our Ifrs session today. I hope it's been helpful and clarified some of the issues you may encounter. So I wonder if there are any questions from attendees? Tianis?
No questions that I think we need to discuss now, seeing that we've gone over time a bit, Ulrika. Thank you.
Then I'm just going to hand back to you.
Thanks, Ulrika. I just want to thank all my presenters, every member of my team. Thanks for your time and effort, and thanks for putting in the time to present today. Really appreciate it. And then thanks to all of you for attending. Thanks for the participation in the polls. We had quite good participation in the polls that we did do. That's always appreciated. Yeah, and thanks for attending. We've got on the slide now, screen now, you'll see our contact details. If you've got any maybe specific questions, you can contact us or contact your audit partner to discuss the potential issues. And have a wonderful Thursday further. Thank you.